Good afternoon. This is Marty Hibbs from Grain Farmers of Ontario. This month, we're continuing with our educational series on futures and options, and we're going to pick up where we left off. The last time we ran out of time, and I was getting into actual calculations on some of our trades. So before we move on to options today, I think we'll just have a look at a couple of those examples so you can see exactly how we calculate our profits and losses. So once we do that, then we'll just head on over to the options and start there. And this should take 2 or 3 sessions, but I just want to remind everybody that if you have any questions, even though this is not currently live, you can email me at mhibbs@gfo.ca, and I'll be happy to respond to any of your questions. When you're doing these forms of webinars where we're not doing live interaction, it's very difficult sometimes to wonder whether or not the public is actually getting what I'm saying. And if you miss a part, it can really get you kind of lost or behind the 8 ball and hard to catch up. So the premise here is to make sure that everybody understands going forward exactly what we're trying to teach. We want to keep it as simple as possible so that we have a thorough knowledge here of exactly what we're trying to show you with regard to hedging or investing in these markets. Okay. So profits and losses. So basically, mark to market, we left off the last time about accounts and margins. We covered all of that. Mark to market simply means at the end of each day, your account, which is your trading account, are settled. And when we say settled, it means the markets are basically closed. And what it is, it's a snapshot of where everything is. And some of the things that are included in this mark to market is your account balances in each account that you have. You could have several accounts. And they include profits and losses at that point. And it's very important to understand when I say at that point, means it's a snapshot. It can change momentarily. It can change as soon as the market opens. But at the end of the day, it'll give you an idea how your account stands and whether or not you are under margin or if you need to send more margin or if you have profits, okay? So snapshot of your positions. So if you have 4 or 5 positions on at the time or open, it shows you whether you're long, say, corn or wheat, or if you're short corn or wheat or soybeans. And each position shows their respective profits and losses at that point. So again, it's just a summary. It will also show you all the margin requirements for the total positions, as well as each individual position. Now, margin being put in one pool or one account can be spread around. So for example, if you're under margin, say for example, on a corn position and you have excess in your wheat position, that's applied. So it's the total amount of margin that's required. And at that given time, if you're making money on one position, losing on another, it's a really good chance that you may not even have a margin call. So again, it gives you an idea overall of where you stand. And then finally, your margin shortfall, including unprofitable positions. So that means that if you have a shortfall overall, then you're going to be notified of it, and you'll get an email with regard to a margin call. Now, today, things have changed a lot in the industry, but a margin call is usually money that's required almost immediately. And this simply means that if you don't have an account set up already or an agreement with the brokerage firm, that they will need you to wire the money. But today, most companies have a situation where they can draw from an account, or you could even have a separate account with that company and give them access to drawing margin from that account so that they don't have to bother you. And as opposed to running to the bank every day and trying to wire money. So that's basically what mark to market means. Now, calculating profits, even though we went through a lot of the trades and the ideas in the last couple of seminars, we didn't really figure out how to calculate your profits and losses. So I'm going to do it as a speculator. Now, there's no difference whether you're a speculator or a hedger. the profits are calculated the same way. So this way it would make it easier to understand if you're a new trader and you're just trading a contract, how your profits and losses are determined. First of all, you have to determine the contract size. And remember, we deal with many, many contracts. As a commodity broker, I dealt with 35 to 45 contracts, including things like crude oil, S&P indexes, NASDAQ, gold, silver, cattle. I think everything except fish. But the thing is, there's lots of different contracts, and everyone has their own characteristics. So with crude oil, for example, there's 1,000 barrels of crude oil on the contract. The grains, however, are pretty much standard. The regular contract on all grains is 5,000 bushels per contract. So that's your multiplier, the 5,000. So once you determine the size of the contract, 5,000 bushels, then you determine the point value. Every penny in wheat, corn, or beans, or oats represents a $50 move, because you have a 1 cent move times 5,000 is $50. So now, next you have to determine how many points you made or lost. So a quick example, today I decide I want to buy wheat at $5. And I'm a speculator, and I buy wheat at $5 and it goes to 5.10. At the end of the day, I go, wow, I'm happy with that. I'll take it. So you close your wheat position out and you've got a 10-cent profit. You take the 10 cents, multiply it by 5,000, and you're talking about $500 profit. And of course, don't forget, because we're dealing with Chicago, we're dealing with the futures markets, it's a $500 US profit. Now that money is yours to do with what you want. You can leave it in your account for excess reserves in case you get a margin call. You can take it out and go shopping with your wife. It's up to you what you do with it, but it's your money. So basically, you take the size of the contract, multiply it by the point value, and that's how you come out with your net profit or loss. Now, there's one thing we always have to include is commission. And even though today commissions are a lot less than they were back in my day, you can trade for as little as $2 or $3 a contract. I remember back in the 80s, it was hard to find a broker that would do it for less than $50, and some would even charge more. With commission, however, you have to subtract it from your profits. So if you make 500 and it costs 2, your profit's 498. But if you lost 500, you have to add it to your losses. So now you have a $502 loss. So that's basically, in a nutshell, how you do your calculations. And again, look at each contract and decide or determine the contract size. So with crude oil, just quickly, if it's 1,000 barrels of crude oil, that means every dollar move in the crude is a $1,000 profit or loss. And of course, it doesn't move in dollars. It moves in pennies. Gold is 100 ounces. So every dollar in gold moves, you make or lose $100. Okay, here's a hedging example I put together here. It's just, bear with me. It's I just slapped it together this morning. So let's say Farmer Joe likes the price of September wheat. We're currently in July. And the futures contract is trading at $5.40 per bushel. So Joe decides to sell half of his crop to lock in this price of $5.40. He calls his broker and he says to sell short one September futures contract at $5.40. As the harvest progresses, the prices decline, and Joe notices that they're now down quite a bit. So after he does his calculations, he feels the market may be in, the bottom may be in, and he needs some cash to pay his bills. So he determines it's time to buy back that position. So he phones his broker and says buy back his futures position, because as we mentioned before, you short first, you cover it by buying it back. So he short the wheat are at $5.40. So now to buy it back, it's currently trading at $4.80. So he receives the difference. So he sold it at $5.40. He covers it at $4.80. That means there's a 60-cent per bushel profit. And if you do the math, it's 60 cents times 5. That's a $3,000 profit. At that point, Joe has unhedged himself or unprotected himself. He now takes that particular wheat to the elevator and sells it, and he gets the current market price, which is equivalent to roughly $4.80. So even though he sells his physical wheat at $4.80, he's made the difference between the $4.80 and the $5.40 in the futures market. So what that did is allowed him to lock in his price of $5.40 on the futures. And when it dropped to $4.80, even though he sold his wheat at the elevator for $4.80, he actually got $5.40 US. And again, now remember, this is the futures contract prices. These are US dollars, and this does not take into consideration local bases or the Canadian dollar conversion. Okay. Here's an example of a short wheat sale. If a speculator decided he thought the price was going to drop, you might want to sell the wheat at $5.40 like Joe did, buy it back at $4.80 for a 45-cent profit. No, actually, that's wrong. I just did that this morning. It's a 60-cent profit. So again, it's 60 cents times 5,000 bushels. You can see there 3,000 profit. So he could have just as easily done it as a speculator. You could have done it. I could have done it. Anybody can trade these markets. And in this case, he just decided he thought for whatever reason the price of wheat was going to go down. He sold it at $5.40, bought it back later at $4.80, and the difference between the two 60 cents is his profit because he sold it and bought it back at a lower price. Make sense? All right. So here's another trade example. Now this time, instead of shorting the wheat or using it as a hedge, we're going to buy wheat. So this speculator decides he likes the price of wheat at $4.25. He puts a futures position on December wheat at $4.25. 2 or 3 weeks later, December wheat's now trading at $4.75. Phones his broker, says, or he does it online himself, sells his wheat at $4.75. The difference is 50 cents, and that's a profit because he bought it at a lower price, sold it at $4.75. So his profit is 50 cents, which equates to $2,500 less his commission. Now that same trade could have gone the other way, in which case he bought the wheat at $4.25, hoping it would go up, but instead it dropped to $3.80. Now he has a 45-cent loss and he can't sleep at night. So he decides it's time to get out of this trade. He phones his broker or does it himself online. He realizes a 45-cent per bushel loss, which equates to $2,250 US plus his commission, which could be anywhere from $2 to $50. So in a nutshell, that's how we do the calculations, and that's how you calculate your profits or loss on each position. Now, currency factors are a big deal, especially in Canada, because let's face it, most of us are Canadian, and that Canadian dollar hasn't done well in most people's eyes lately, but in my eyes and a lot of farmers' eyes, it's done very well because we're currently trading at around the 130 level. What that means, quite simply, is that back in 2011, the dollar was at par. So if the price in Chicago wheat was $5.40, the price in Canadian wheat is $5.40, but give or take the difference in the basis. A scenario where the Canadian dollar is lower and it's trading at 90 cents, the multiplication factor is about 1.11, which means that every dollar we have in US, we get $1.11. Great if you're selling something to the US, absolutely terrible for all the wives here that want to go shopping in Buffalo. Not good. So in that case, the wheat that we sold at $5 is now $5.55. And the next one is more closer to what resembles today, where the dollar is close to 70 cents, although it's a little bit higher than that. But in this case, if the dollar were to get to 70 cents US, your multiplier is 143, which means that when we sold the wheat at $5, we multiply that by 1.43, and we're getting $7 Canadian, $7.15 per bushel. So the good news is that for those farmers out there right now, it could be a lot worse if our dollar was at par. So this lower dollar is really helping them as far as what they're getting returns on their crops. Okay, so that was just, as I said, the end of the last seminar, and I want to move on now to starting options on futures. Again, I want to mention that I usually do these as seminars, and they are usually 6 to 8 hours long, a full day session we do. And we get a lot of interaction. And I just want to explain, as I just did to Paige a few minutes ago, when I'm speaking to an audience, if I stumble across something that I'm taking for granted and people don't understand what I'm saying, they'll quickly put their hand up and say, "What are you talking about?" Then I realize that my 35 years experience, I assume everybody knows what I'm talking about. So I backtrack, and that way we don't lose the sheep out of the herd, because the problem is if you're sitting in an audience and somebody goes over your head a little bit, you get lost, and then kind of demoralizing for the rest of the day because you don't really know what's going on. You've kind of fell off the track, and you get that glazed look on your eyes. So what I did today is I scrapped this entire options and futures. Actually started it yesterday. The options section I've rewritten, And I've tried to rewrite it with a look that I'm not going to have too many interactions. I'm going to keep it as simple as I can. Having said that, if there's questions that you do have on the material we're going to cover, please email me and I'll be more than happy either to answer your email or even talk to you on the phone when I have some time to try and clarify, because it's important that you understand as a GFO member that these options are an amazing tool and they can really be helpful even for a small farmer. And it's just another tool in your tool chest. If you are a carpenter and you only have a hammer, you're kind of limited on what you can build. A saw does a different job, and these tools, like options, have a specific place. And it's amazing when you have the right tool what you can do with these markets. So let's get started with options on futures. What is an options contract? An option contract gives the buyer of the option the right, but not the obligation, to take on a futures market position before a given date. They pay the price for this right, but once the price is paid, there is no other cost. There's no margin calls. You're basically buying a ticket almost like on a lottery in the sense that you're making a bet. And if it pays off, it's just as good as being in the actual futures market minus the premium that you're going to be paying for that right. So if I were to buy an option on wheat at $6 for December, and somebody else were to have a futures position on wheat for December, and wheat went to $10 a bushel, I would benefit the exact same amount as the guy in the futures minus the premium that I paid for that right. So it's an amazing tool, but the key is that you do have to pay the premium, and we'll explain that a bit further. So again, an option contract gives you the right, but not the obligation. And basically that means is it's your right. When you buy an option, you call all the shots. If you buy an option to say that you're allowed to buy wheat at $5 and it goes to $5.50, even though it's making you money, you can still say, no, I don't want it. So that's the beauty of an options contract. Now, as far as types of options, there's basically two different types of options, and we'll start with the very basics. One is called a call option, and a call option gives the person that buys it the right to buy something. What is it? It could be a car, it could be a house, it could be a farm, it could be anything. These options are very broad-based, and they're used every day of your life, and we'll explain in a bit what exactly I'm talking about. But in this case, we're confining the options to futures contracts because that's what we're concerned with. So when we say an option gives the owner the right to buy something, in the futures market, it gives you the right to buy a futures contract. If it was in an art gallery, it would give you the right to buy a piece of art. Now, that's the first type. The second type is a put. And a put gives the owner that purchases it the right to sell something. Now, why would you want to sell something? Well, maybe if you're a farmer and you were trading corn and corn got to $7 a bushel and you thought, wow, this is a great price. By buying this put option, it gives you the right to sell that corn at the price you want. So if corn is at $7 a bushel and you really like it and your corn's in the ground, and you can't really sell it unless you forward contract it, but it gives you the right to sell it there. And it takes some of the risk out of the market so that if corn were to go back to $4, you've sold it for $7. So a call gives you the right to buy something at a specific price for a specific time. And a put option gives the owner of the option the right to sell something for a specific price or at a specific price for a specific time. And in each case, you buy these options, you pay a premium. Now, every option contract has a buyer and a seller. So I can't just fictitiously buy an option on gold because I think it's going to go higher unless somebody sells it to me. The same with the put option. I can't buy a put option on a corn contract unless somebody wants to sell it to me. So every option has a buyer and a seller. And of course, these are cleared through the clearing houses, just like the futures contract. You have no idea who you're dealing with. It's a very, very liquid market. And when you go in and say, I want to buy a put on corn at $4, instantly, providing you're paying the price they're asking, you'll be filled and you'll have your option. That's how you could transact these. Okay, so some of the option terminology that we're going to discuss today, obviously, is what an option is. We've already covered it. A call, we'll clarify exactly what a call means, a put. And we'll differentiate between a buyer and a seller of an option. We'll also look at what a long position is versus what a short position is. We'll discuss premium and exactly what that is, a strike price, and finally, an exercise price. So those are some of the terminology that we'll be discussing and some of the terms that we'll go through the course. It may not all be in this session. It might be in the next session, but those are the basics that we'll be covering. So by the time you're finished this webinar, you should have a good handle on all of these terms. So options on futures. So they basically work the same as options on anything else. But the beauty of the futures contract is they are standardized terms. So for example, standardized meaning when you buy an option on a wheat contract, what you're buying is an option to buy a futures contract on wheat, which we know is 5,000 bushels. And it trades on the Chicago Board of Trade. And if it's Minneapolis, they can trade there as well. And it'll be spring wheat if it's trading on Minneapolis. So when you're buying the option on the futures contract, you know exactly what you're getting. You're getting the contract of the underlying futures position. It could be on crude oil. It could be on gold. But in this case, we're going to try and stick as close as we can, as I said, to the grains. You can also buy options on stocks, bonds, currencies, hogs, cattle, individual ETFs or group ETFs. So there's so many things you can buy options on. The benefits of options on futures. In one case, especially for farmer members that are listening, we like to consider these as insurance policies. They could be used like an insurance policy to limit your losses. For example, if you are in the market right now and you're growing a corn crop and you're concerned about the downward pressure on the prices, especially given all that's going on in China, you might want to insure your position so that you know your break-even price, let's say, for example, is at $8 a bushel US, and we're trading at 10, and you're really concerned about it, and your crop's in the ground, and you do want to get more money, so you don't really want to forward contract it because once you do, basically it's gone, or you don't want to sell it. So what you might want to do is consider buying a put. And what the put does is it puts a floor in your contract. So for example, if beans are trading at $10, you might say, look, I need to break even, make a little bit of money. So I want to buy protection at $9 out as far as, say, September or October, because that's when I'm going to harvest my crop. So what you might do is look at buying a $9 November soybean put. That basically ensures that you're going to get $9 US for your beans between now and September. And that's the worst case scenario. So if beans don't get down there, you've paid the premium and you've lost the premium, somewhat like your insurance you buy on a car. A perfect example of an option is car insurance, because every year we buy an option by giving the broker our money and saying, if we get in trouble, you're going to cover us and you're going to fix our car. And I've got an example later on with that. So it's the same idea here. It puts a floor in there and you're paying that premium like house insurance, like anything else. And if you don't use it, you lose your premium. But if it ever happens that you need it, it's there to protect you. So speculators also use these, but they use them for a different reason. Speculators use options to try and make money on market movements, and they want the risk. They don't want to avoid risk like farmers do. They want to try and capitalize and they could find out from their Ouija board that a stock is going to go up or whatever, or they may have a dream. You know, we have all kinds of cases about people, why they buy things, but speculators like to ride the coattails, and all they want is price movement. And if they're right, they can make money. And if they're wrong, they can lose money. But speculators use these markets, and they add a lot of liquidity in these markets, just like they do in the futures markets. And again, with the farmers, it's mostly used as a hedging tool to offset losses from an adverse cash price movement, like we've seen in the beans in the past couple of months. With the trade embargoes and the hog situation in China, we've had a drastic drop in the price of beans. And this would be a case where somebody might employ a soybean put option just to protect it and make sure the floor is in, so that if something really dramatic were to happen, that they're not going to end up selling their beans at a loss and not making any money on the crop at all. So there is definitely a place for these. Now, of course, people may say, and I know I'm going to repeat myself, but they may say, well, what's the difference in the futures? Well, the problem is with a futures position, if beans are at $10 and I'm worried they're going to go down and I sell them in the futures, if I'm wrong and they go to $12, I've basically locked in that $9 price, and I can't do anything about it. And I'm stuck in there, and I can't make any capital gains or any profit going forward, because what I'm making on my cash beans, I'm losing on my futures position. And the difference there is that with the option, you pay the premium, and it's your choice. If you don't exercise it, that's up to you. Why would you sell beans at $9 when they're trading at 12? You just let the option expire. You've paid your premium, and now you've done what you needed to do. Every option has underlying futures contract, and they're called the underlying. And in this case here, some examples could be, we have 1,000 barrels of crude oil, 100 ounces of gold, 5,000 ounces of silver, 5,000 bushels of grain, 100,000 Canadian dollars. Yeah, even the dollar is used in these futures markets. The value point of the Standard & Poor's, 40,000 pounds of cattle, and so on and so on and so on. There's so many different options out there. And again, the bottom line, don't forget, with options, just like futures, is this is price discovery, okay? This is how people determine the real true value of what something is worth. It's when they trade these markets, and you see what they're willing to pay. At times of really high volatility, those option premiums will go up. Just like if you have a car accident, the insurance broker is going to say, wow, you're a bit of a risk. I'm going to charge you a bit more. That's what happens here. If these markets get really volatile and there's a chance like that this soybeans could go to $8, you're suddenly going to find that the option premiums have doubled or even possibly tripled. Why? Because that's the risk that the other party has to take. Don't forget it. You're buying it from somebody else. There's two sides, a buyer and a seller. So the person selling you that option is taking the opposite side of the risk. He's not worried beans are going to go down, but when the market forces look like they could be, the supply-demand situation dictates that those premiums are going to be a lot higher, okay? We'll talk about that more later. So again, let's review the call option. Call option gives the buyer of the option the right, but not the obligation, to purchase the underlying asset of a fixed price, strike price, for a specific period of time called the expiration date. And the potential profit on a call does not come without a cost. Of course, you have to pay the premium. Okay. The buyers of the options pay a premium to the seller of the option. So again, the seller of the option is dictating what he wants for the risk that's involved. So you have the right, but not the obligation. If you were to buy a put option on soybeans, it gives you the right to sell soybeans, say at $10. If soybeans don't go below $10, would you exercise your right? Probably not. Why would you sell it for $10 if they're on the open market at 12? So you just step aside and say, thank you. No, I'm not exercising my rights. It's my rights, and I'm not selling them. But if it went to $9 and you have a ticket in your hand that says I can get $10 for them, of course you'd exercise that right. Okay, so that is the right of the buyer. The buyer of a put option has the right, but not the obligation, to sell the underlying asset at a fixed price. Now, the fixed price is the strike price. for a specific period of time, because we'll get into this also. Every option expires just like a futures contract expires. They don't go on to perpetuity. They have an expiration date. So obviously, if this is an option on the futures, it has an expiration, and it will be preceding the actual expiration date of the futures contract. So again, potential profit on a put does not come without cost. There is a premium to be paid. The buyer of the option pays the premium to the seller of the option. Here's an analogy. Now, I keep changing them up, but I just thought I'd give you a different one today. So there's a house that I'm looking at purchasing down the road, and it's fairly priced, and I'm very interested in it, but I have inside information that there's a big piece of land across the road from there, and that land is currently under review because they're looking at utilizing the land and developing something there. And from my inside source, I understand that it could be a park, which would be kind of nice for my kids. Or the second one, there's a rehab center there. Don't know if I'd really want a rehab across the street, meaning that it could adversely affect the price of the house. Maybe it will, maybe it won't. But the idea is I'd rather not, because even though I feel bad for the people that are having trouble, it has a tendency to have some effect on my property price. So what I want to do in this case is I am interested in purchasing. So I'm going to approach the owner of the house with a proposal. And the proposal is I am willing to pay $500,000, her asking price. This $500,000 is called the strike price. Every option has a strike price. In this case, the strike price is $500,000. I am willing to pay the owner, let's say it's you, Paige. I'm going to give you a $5,000 option premium. That means that premium is yours to keep no matter what happens. But there are stipulations. So this is called a premium. What I want from you is I want 3 months that you will not sell the house to anybody else. If you're willing to do that, then it is my right in 3 months to come back to you or before then and say, okay, I want to proceed with the deal. If I proceed with the deal, you get your $500,000 full asking price, plus you get to keep the $5,000 as well. Not a bad deal. Where somebody may come along, offer you $480, I'm not haggling. I'm going to give you the whole price plus the $5,000. Either way, the only thing is I may not buy the house. That's my right as the option holder. Okay. So the buyer of this option has all the rights. For whatever, I don't need a reason. I can just say I decided, no, tomorrow I'm not buying your house. That's fine. You can put it back on the market and resell it and keep the $5,000. Not a bad deal. Now, if that doesn't satisfy you, you go, no, well, you know what? I don't want to do it for a lousy $5,000. Give me $20,000 and I'll do it. That's where the bidding and asking comes in, and that's where the supply demand comes in. So if the market is volatile, and let's say, for example, it's a Toronto house that you're trying to sell, you might get $500,000 the next day anyway, because the market is very hot, and you may even get a bidding war. So you'll probably say, Marty, forget it. I'm not doing it for $5,000. But if it's somewhere where the market is not very volatile or not very hot, and maybe you're asking a bit much anyway, you may sit on that property for 3 or 4 months. Okay. So there is where the premium comes in. So again, we've established the strike price, which is the price you want for the house. Now it's $500,000, but the strike price on the beans, we talked about protection. We decided we would like to protect ourselves at $9 and down. That's the strike price. Now it could be 10, but if it's 10, guess what? You're probably going to pay more money for 10 because it's a lot closer. So you pick and choose your strike price. You pick 9 because it'll give you a profit and give you protection. So that's the strike price. The premium is the amount of money you're going to pay for that option. Now, the premium, there's a lot of things that influences the premium. The amount of time you want to buy, the price you want to buy it at, and we'll go through those later. But right now we've established what a strike price is and what the premium is. And that you, as the option buyer, whether it's a put or a call, have all the rights. So, okay, here's the possible outcomes. So the vacant land is approved as a park. So the home may actually go up in value because a lot of people now say, wow, nice park across the street. I don't have to worry about neighbors there. It's kind of a nice little touch. So that could actually affect the property price of your house. The seller keeps my premium, so the seller's quite happy. I'm happy. I'll make the deal. I'll close the deal. I'll give her $500,000. She keeps the $5,000, so that's what she got, full price for her property. The second one is I get word back from my undercover friend that, nope, they're putting a rehab in there and it's a pretty big one. So I go, okay. Now my concern is, obviously, is I don't really know if I want to live next door to a rehab center. Plus the fact that if I'm buying it for $500,000, I think I'm overpaying, because I don't think everybody will want to live next door to a rehab center. And in this case, it may be worth closer to $400,000. So again, because I paid you $5,000, I've lost my $5,000, but I say, thanks, Paige, but no thanks. So at that point, you're free to list your house again. And I might even share with you what I found out. So you might want to list it at a more realistic price. Okay. Expiry date. All futures contracts, as people know already, that trade futures have an expiry date. So once the expiry date comes, the contracts no longer exist. They're gone. So if you're looking at December corn, once we get into December, every position in the corn is settled and there is no contracts, and that contract is gone. So because the actual underlying, which is the futures contract, expires, it's obvious that the options also would have to expire. So what happens is the options expire previously to the expiration of the underlying contract. Okay. And there's no set schedule. If we're dealing with the futures contract of, say, S&P, it could be the same day. Currencies could be the same day. It's cash settled. But with the ones we're concentrating on, which is the grains, they usually expire about the third Friday of the preceding month of the future. So if we're looking at December, it would probably be the third Friday of the November month that these options would expire. Now, what happens on an expiration of options? You've got a couple of choices. You can either exercise your option, or you can let it sit there and go to zero. Okay, now, just explain that a little bit. We have an option on wheat at $5, a call option to buy it. Wheat is at $5.05, which means it's worth 5 cents. Make sense? Because if we buy it, we're allowed to buy it at 5 and it's at 5.05, it's worth $250. So probably what we would do is sell it before it expires that day. Now, if we don't sell it, what would happen is, because it's what we call in the money, and we'll get into that later also, it will automatically be exercised for what it is that you're buying. So if the option is on a December wheat contract, you would find yourself long a December wheat contract in your account the next day. You get what you pay for. If it's an option on the house, I get the house. If it's an option on a futures contract, you get the futures contract. So it's important that if it's in the money, which means it's got value that last day, that you offset it. You don't want any surprises. But your broker, if you have one, will make sure, hold your hand, that you don't do that. He'll be calling you and saying it's time to get out of it, take your profit or whatever. But just to keep in mind that these options expire before the futures contract. And the reason being is because, let's say, for example, I didn't do anything with my option. It was worth a bit of money. The wheat was at 5.05. I did end up with a wheat contract for December in my account at $5, and we're at 5.05. The next day when I see it, I still have an opportunity to do something or to get out of it. Okay. There's a variety of dates on expirations of options. There's no set price, there's no set time for them. They're all over the place. It's as the market dictates. There are options for what they call short-term trades. For example, let's say somebody was trying to sell wheat in the beginning of October. Let's go back. Yeah, let's say in August. They could sell a September contract that expires in August. If I only need a protection for 3 weeks instead of the whole month, instead of paying the premium for a whole month, I could go with what they call a short-dated option, which expires every week. We won't get into that, but they're just to summarize, their option expiry dates aren't generally fixed. They're variable. They're all over the place. So it's important when you're trading any of these instruments, just like the futures, that you go to the details of the contract to tell exactly when they expire and what dates they expire. So, for example, like I said, you may buy corn, an option that expires in October on corn, but using the December contract. So there's lots of different variances. So put options, again, we spoke about them, are, this is another little analogy. So I buy home insurance on my cottage, which is basically price protection in case it burns to the ground. I guess that's the main reason, or a break-in. And they're charging me $1,000 a year for this premium. Just like on the option, I'm paying this premium, knowing there's a good chance it's gone, it's dust. But the beauty is it limits my responsibility to that $1,000. So the year I buy it, my cottage is insured for $200,000. I have a small fire, and the fire does some damage, and it's $20,000 damage. Well, right away, my insurance decides that they'll honor it, and they pay for the $20,000 for the repairs. And of course, I paid the $1,000, so I basically saved myself $19,000. Now, as we both all know here, that's not usually the way it happens. We've been paying life insurance or home insurance on our homes since we had them, and they just keep keeping it year after year because not too many brick homes burn down today. So that's the idea about how the other side of the token or the option seller would make money. And it's the same way with people that sell grains. There's people that sell options on grains to you that will keep the premium month after month after month. Now, if they get on the wrong side of the market, sure, they could take a big hit, but not necessarily, and they make that premium. So consider the guy that's selling you the option. People say, well, how do they do it? They're at risk. They are, but they got to realize how many people actually put a claim in. So with your cottage, scenario B would that it burns to the ground. In that case, it's a $200,000 bill from the insurance company. It cost you $1,000. It was well worth the protection. It's like a put option. But then again, they have thousands of people paying that $1,000 a year. So they're not hurting. I'm sure they're doing well because otherwise they probably wouldn't be in business. But again, the put option can be likened to your house insurance or your auto insurance. It's a premium you pay for a privilege, and it's up to you whether or not you use that privilege. In the case of the damage on my cottage, if I only had $1,000 worth of damage, I may not submit a claim. Why? Because we both know what happens when you submit a claim. Your insurance rates will probably go up. So what I might do is just eat it. So the idea here is that it's your choice as the purchaser of the option, whether or not you want to exercise your rights. And I keep emphasizing that because it's very important to understand as the option holder or the buyer, you have all the rights. Okay, so basically what we're dealing with is a thing called derivatives. And a derivatives is easily defined. A derivative is something that is derived from something that has value. Okay, so in the case of a corn contract, the futures contract derives its properties from actual corn. So the underlying of a futures contract, if I wanted to, I could say, I bought this corn, I bought a call, or I bought the corn, I want my corn. And I could actually get a receipt or pick it up. Same with the gold. But now an option is not an option on the corn. It's an option on the contract on the corn. So we have two stages of derivatives. So they're both derivatives and they're not the real product. And believe it or not, our monetary system today, I won't get into it, is basically a derivative because it is a bet on a bet on a bet in the sense that when you take your money to the bank in the fractional reserve banking system, they keep legally somewhere between 5 and 10%, and then they loan the rest of it out to other people. So derivative markets can be dangerous because, again, it's a side bet. But at the same time, you got to understand what you're betting on. So in this case here, it's an option on a futures contract, not an option on the corn directly. However, they are linked together in the sense that you could exercise the option on the futures contract. And once you get the futures contract, you could exercise your rights to take delivery of the corn. But anything like this is called. So the main terminology that we're going to look at, and we're getting short on time today, we're not going to get much farther, but we're going to be covering the main parts of any option, okay? The underlying assets. So again, what's it an option on? Is it an option on a house, an option on a car? We make decisions every day, and we have options. And that's basically all an option really is. Any decision we make, we have an option. We can take our car to work, or we can take a streetcar. We choose. If you take your car, you've got the privacy. If you take a streetcar, you got to pay the tickets, the fare. So those are options, and that's all it simply means. You got choices. So all these options have underlying assets or underlying, they're called underliers, believe it or not. So you got to make sure what you're buying. So the three main components in an option is the strike price, which is the price that you decide you want to attack. So in the case of a soybean farmer, quickly, if beans are at 10 and I'm worried about getting below 9, I might choose a $9 strike price. If I don't want to pay that much premium, I might go all the way and say, okay, I only want an $8 put. Now, if I buy an $8 put, I'm not protected from 10 down to 8. So my risk is a lot more, which means my premium will be a lot less. Make sense? Okay. The second thing we learned is the premium itself. This is the amount of money you're going to pay for that right. Okay. So every option has a premium attached to it. So the farther away you go from where the asset is trading, the cheaper that option will become. So if I want to buy a $7 call option on wheat, and wheat's only at $5, what's the chances of wheat getting to $7? It's got a long way to go. So the first $2, I won't even make any profit. Once it gets there, I still have to get back my money I paid for the option. So my break-even price might be up around $7.20 or $7.25 before I even start making money. So that is the premium, and that is determined by many factors, which we'll discuss the next lesson, okay? And then finally, the expiration date. This is the last date that you can exercise your rights. If you get past the expiry date and phone in the next day, say, oh, I forgot my option expired. I want to buy it or sell or take my profit. No, sorry, it's done. It just goes dead. It's flat. You have no rights. Your rights are gone. Almost like the statute of limitations. It's gone. Anyway, I think we've pushed 50 minutes into the session. There's a lot to cover, and I didn't get quite as far as I thought we would, but I just want to make sure that we're trying to establish the base here, so going forward we can build on it. If you have any questions, because it's not live today, I invite you to email me at mhibbs@gfo.ca, and I'll be happy to respond to your questions. And I guess next month, sometime in August, we'll be doing the next series, which will be a continuation of options. And from what I understand, the whole 5 or 6 sessions that we've done on futures and options will be in one place, accessible to all GFO members, hopefully within the next 3 to 4 weeks. Anyway, thanks for your time, and until then, have a great summer.